What if I told you that most money is not discovered, not printed first, not dug out of a vault guarded by men named Frank with mustaches? What if I told you that most modern money is typed into existence the moment somebody signs a debt agreement? Not metaphorically, not spiritually, not kind of, sort of, if you squint and hate economics. I mean literally. A bank approves a loan, numbers appear in an account, new bank money is born. That is not fringe theory. That is how modern banking works, according to the Bank of England, the BIS, and the Federal Reserve's own descriptions of deposits, reserves, and the money supply. And once you see it, you can never unsee it. Because this means the economy is not just running on money. It is running on promises, on balance sheets, on future income dragged into the present. And that, my friend, is where the story gets weird. The great money illusion. Most people imagine money enters the world like this. Step 1, the government prints money. Step 2, banks hand it out. Step 3, we fight over it in traffic and at the grocery store. Simple, clean, beautiful. Totally wrong. In modern economies, most money exists not as paper cash, but as bank deposits, numbers in accounts. And those deposits are created largely by commercial banks when they make loans. The Bank of England states this directly. The majority of money is created by commercial banks making loans, and banks do not simply lend out existing deposits. Read that again because it sounds illegal. Banks do not mainly wait for grandma to deposit $10,000 so they can lend that same $10,000 to Chad for a jet ski and a doomed smoothie franchise. No. When a bank makes a loan, it typically creates a matching deposit in the borrower's account. The BIS describes this as banks generating deposits by extending loans, and those deposits shrink when debts are repaid. That means the loan does not come from the deposit. The loan and the deposit are born together, like twins. One is an asset to the bank. The other is a liability to the bank, and both arrive dressed as accounting entries. Romantic, isn't it? Watch a dollar be born. Let's make this painfully simple. You walk into Bank Olympus and ask for a $10,000 loan. The bank approves you. At that moment, the bank does two things. On one side of its balance sheet, it records a loan asset worth $10,000 because you now owe the bank $10,000. On the other side, it records a deposit liability of $10,000 in your account because the bank now owes you access to those funds on demand. That deposit is new money in the banking system. The Bank of England explains that when a bank makes a loan, it simply credits the borrower's account with a higher deposit balance. At that instant, new money is created. So let's pause. Before the loan, no deposit. After the loan, deposit. Money appeared because debt appeared. That is the punchline. Debt is the womb. Money is the baby. And yes, economists say it less dramatically, because economists are legally required to make everything sound like dry toast. Wait, so banks just create money out of nothing? Now, before somebody bursts through the wall yelling, "So banks are wizards?" Calm down, Gandalf. Banks are powerful, but not unlimited. They cannot just create infinite money with no consequences. Their lending is constrained by profitability, regulation, capital requirements, liquidity risk, the availability of credit-worthy borrowers, and the central bank's monetary policy environment. The Bank of England explicitly says the amount of money created ultimately depends on the monetary policy of the central bank, while the Federal Reserve describes reserves and interest on reserve balances as tools for policy implementation. So the real system is not banks print magic forever. It is banks create deposit money through lending, but inside a cage made of regulation, funding pressure, settlement needs, risk management, and central bank policy.
That is less catchy for a thumbnail, but much better for not embarrassing yourself in public. What happens when you spend the loan? Now here's where the rabbit hole gets deeper. Suppose you spend that $10,000 on a used car. If the seller uses the same bank, easy. The bank just moves the deposit from your account to the seller's account internally. But if the seller banks somewhere else, then your bank has to settle with the other bank using central bank reserves, the special money banks use among themselves. The Fed describes reserves balances as deposits that depository institutions hold at reserve banks, and central banks use those balances to implement policy and support payment and settlement systems. So consumer money and bank money are not identical things. Your checking account balance is a commercial bank deposit. The banks settle final payments between each other using reserves. That distinction matters because it means banks create deposits through lending, but they still have to survive the plumbing of the payment system after those deposits move around. So yes, they create money, but no, they do not control reality. That job is still reserved for toddlers and central bankers. What happens when repayment destroys money? Now here's where we do the funeral. When you repay the principal on your loan, the bank's loan asset shrinks. At the same time, the deposit used to make that repayment is reduced. The BIS explains that banks generate deposits when they extend loans and destroy them when the debt is repaid. So money is not only created, it is also extinguished. This is one of the strangest facts in economics. A great deal of what we call money is temporary. It lives as long as corresponding debt lives, which means the system is constantly doing this: create credit, create deposits, spend, repay deposits, repeat. It's less like a pile of coins and more like a lung. Inhale, new lending, exhale, repayment, and the whole economy lives or panics based on the rhythm. The interest problem everyone argues about. Now somebody always asks, okay, if banks create the principal, where does the interest come from? Great question. The answer is not that the system mathematically requires instant collapse. Interest is paid out of the existing flow of money in the economy: income, business revenue, wages, sales, transfers, refinancing, and new credit creation. But at a system level, heavy dependence on credit growth can make economies vulnerable, because shrinking credit can also shrink deposit money and economic activity. BIS and central bank literature consistently link bank credit creation with the expansion and contraction of deposit funding and broader financial conditions. Translation: the issue is not that there is physically no money for interest. The issue is that a credit-driven system tends to hunger for ongoing cash flow and often ongoing new lending. So when lending slows hard, the system can start coughing. Businesses feel it. Households feel it. Politicians begin speaking in haunted PowerPoint, and suddenly everyone discovers the phrase liquidity conditions like it's a demonic incantation. The big misconception: banks don't just lend savings. Let's kill one myth with kindness and a flamethrower. The old school story says banks are mere middlemen. Savers deposit money, banks gather it, banks lend it out. But the Bank of England explicitly rejects this as a description of modern money creation. Banks do not simply lend out deposits that savers place with them, nor does the simple textbook money multiplier describe how lending happens in practice. That matters because it changes how you see the whole economy. Banks are not passive buckets. They are credit creators. They do not merely redistribute existing purchasing power. They can create new purchasing power when they extend credit. That's why finance has such gravitational force over the real economy. A loan is not just paperwork. It's newly minted spending power with a repayment schedule attached like a tiny ankle monitor. So is every dollar really born in debt? Now, here's where we earn trust by being precise. The title says, How Every Dollar is Born in Debt. That is emotionally powerful, but the technically accurate version is this. Most money used in the modern economy exists as bank deposits, and those deposits are commonly created alongside debt when banks make loans. Currency is different. Paper cash is a liability of the central bank, not a commercial bank loan deposit. The Fed's money supply explanation includes both currency and balances in bank accounts, and the Bank of England distinguishes currency, reserves, and bank deposits. So the cleaner line for the audience is most dollars you use digitally are born when debt is created. That is still mind-blowing, still true, still enough to make you stare at your banking app like it owes you an apology. Why does this change how you see the world? Once you understand loan-created money, the whole world starts making more sense. Why do asset bubbles swell when credit is easy? Because new lending can
Create new purchasing power. Why do slowdowns hurt so much? Because when credit tightens, money creation slows, and repayment keeps destroying deposits. Why do central banks care so much about interest rates? Because rates influence borrowing, bank behavior, liquidity conditions, and therefore the pace of money creation across the economy. Central banks describe monetary policy as the ultimate limit or framework within which bank money creation occurs. This is why money is not just a thing. It is a system of claims, a map of who owes what, a giant social ledger held together by confidence, law, and settlement infrastructure. Underneath the shopping apps and debit cards and cheerful ads telling you to treat yourself, there is a deeper reality. Modern money is often debt wearing a friendly costume. The human angle. And this is where the story stops being abstract. Because if money enters circulation through lending, then debt is not a side issue in modern life. It is part of the operating system. Mortgages, business loans, credit lines, government securities, consumer finance. This does not mean debt is always evil. Credit can build homes, launch companies, smooth cash flow, and fund productive investment. But it does mean one thing very clearly. When a society depends heavily on debt-based money creation, then the quality of its debt matters. Good debt can build. Bad debt can hollow out. Productive lending can expand capacity. Speculative lending can inflate illusions. And that is not just economics. That is civilization management with spreadsheets, which is somehow more terrifying than dragons. So here is the secret hidden in plain sight. Most modern money is not a pile of pre-existing stuff passed from saver to borrower. It is born when banks create deposits through lending. It circulates as spending power, and it disappears as debt is repaid. That means money is not merely wealth. It is relationship. It is obligation. It is trust organized into numbers. And once you understand that, you stop asking only, how much money is there? You start asking the better question, what kind of debt is creating the world we live in? If this changed the way you see money, comment, "Debt builds money." And for the next episode, why modern economies need debt to function, the counterintuitive truth. Because now that you've seen how money is born, the next question is even bigger. Can the system survive without constantly creating more of it?